Next to the stage, we've got Tom Woodroof from Mutual Credit Services. Thanks for joining us, Tom. Please join me in welcoming Tom to the stage.
Thank you very much. Good afternoon, everyone. I'm Tom Woodroof, a co-founder of Mutual Credit Services, and we describe ourselves as a network fintech, which is a bit of an unusual term, but I hope over the next 5 minutes I'll give you a sense of what that's about. So, me and my co-founder, I'm actually a physicist. I did my PhD in applied nuclear physics at the University of Liverpool, and my co-founder, Dill Green, is a former architect and a serial founder. And so neither of us have a traditional finance background, but in the last couple of years of working together, we've become, I think, recognised leaders in the emerging collaborative finance space, which I realise is another slightly unusual term, but again, hopefully this talk will give you a sense of what that is all about. And what that really involves, to a large extent, is really looking at tools which are already in use within the mainstream financial and the corporate sectors, and finding ways to adapt that for the real economy, and in particular SMEs. And really the driver for this and the opportunity is that if you look at conditions in the real economy, that graph is from the Office of National Statistics, and we can see things like late payment, bad debt, inflation, increasing energy prices are driving huge numbers of SMEs to insolvency. And the question is, of course, well, what can we actually do about this? And our analysis is that at the moment there are two kind of dominant lenses for looking at this problem, neither of which are actually able to address the root causes. And the first lens is the individualistic, atomistic, one-by-one approach, looking at the balance sheet of a business, looking at its accounts payable and receivable, and saying, well, perhaps we can go to an invoice factor, or perhaps we can take out a loan, and go even more into debt just to keep ourselves above water for a bit longer. And that has its place, but it's not, of course, going to address systemic issues around over-indebtedness and lack of productivity. The other main lens is the statistical, aggregated, top-down policy lens, which the government gets from doing things like survey data. And again, this can be a useful way to understand problems, but actually any intervention which comes from the top down, from the centre, based on an aggregated statistical lens is always going to have unintended consequences and is not going to be able to address the individual circumstances businesses or communities find themselves in. And we maintain that there's actually a third lens, a kind of missing middle, if you want. It's not micro, it's not macro, it's meso. And this is what we see as the network lens, and this is where our concept of a network fintech comes in. And Julian was talking earlier about the fragmentation of data, but actually what's happening at the moment is that invoice data is becoming increasingly digitized, and lots of accounting software packages are starting to become more interoperable. And so actually accessing data about businesses' outstanding obligations to each other, their invoices, is becoming entirely feasible. And if you can collect this data, it becomes entirely possible to apply some very powerful and quite transformative approaches from network science in order to look at interventions in the economy as a network which can actually directly address the root causes of systemic indebtedness and thereby help individual businesses, but also lead to some quite interesting emergent outcomes, which I'll talk about very briefly in a minute. But just to explain what this is showing, this is some data we collected in Lancaster. And we basically did a bit of a survey. We went round to small businesses and we said, can you tell us a bit about your local trading partners? And so the nodes show businesses and the arrows show their payment obligations. And I'll give an example of one of the very simple but quite powerful things you can do if you look at this network and apply some fairly simple tools. And so one thing you often find in these trading networks, once you reach a certain critical density, is that actually you find loops. And the interesting thing about loops is that they're these closed structures where everybody owes each other money. And by default, at the moment in the economy, they're not actually resolved. And a loop is a gridlock situation. All of these businesses can look at each other and go, well, I can't pay because I haven't been paid yet. And unless one of them has some working capital or goes and gets a loan, often these gridlocks will cause systemic late payment. But actually, each loop is also an opportunity. You can simply cancel out the smallest amount of debt common to all obligations in the loop. It turns the loop into a chain, which is much more easily resolved, and it minimises the amount of money everyone needs to settle their obligations. And if you have a systematic way of collecting that data, and running that analysis, you can imagine clearing large amounts of debt from local economies. And so that's exactly what we're building. The outcomes, in short, are for individuals, cash flow is king. For the business community as a whole, systemic late payment reduces. And we argue that actually this is incentivising the circular economy from the bottom up, with the circular economy being a really key part of efforts to adapt and mitigate to climate change. I'm very sorry to say to Manchester that we're doing this first of all in Liverpool. We're launching Local Loop Merseyside, and that's us. We are very interested in talking to anyone who has a network view of the economy and is interested in making more of their network understanding. If you're a Chamber of Commerce, a local authority, for example, or even just an anchor business, please come and talk to us.
Fantastic. Thanks, Tom. Questions for Tom?
So I'll ask you, Tom. What sort of reception are you getting in your conversations today? You're obviously doing well in Liverpool with that. What were the things that made the penny drop with the guys over there?
I think one of the framings which works really well is the observation. And thanks, Julian. That's taken us a long time to figure all that stuff out. Is exactly how you frame these things and present them. But one thing which goes down really well is the observation that, as I briefly alluded to, these kinds of mechanisms are completely normal, unconventional in the mainstream financial sector. Banks have been doing this kind of thing for hundreds of years in their clearing systems. And in fact, every time a group of friends goes to the pub or goes on holiday and uses something like TriCount, you're using a very similar principle. And again, it comes back to this missing middle. The big global institutions are doing this and benefiting from it. Ordinary people do it in the pub by buying rounds for each other without even thinking about it. But there's the whole of the real economy in between, for which these tools are just not available yet. And that is a way of presenting it which certainly seems to go down very well with, for example, Chambers of Commerce, because we say we can turbocharge your network using these financial tools.
Brilliant. Thank you very much. Thanks for joining us, Tom.
Just before,